If you are working in tax or, high-stakes corporate litigation, the regulatory world doesn't just move fast. It accelerates.
It really does.
The sheer volume of pronouncements, new rules, deadlines, it feels like we're trying to read a fire hose.
And that fire hose is currently pointed directly at the core of your compliance and litigation strategy. The sources we looked at, this high-density digest from the TaxCorp Daily, it shows a massive simultaneous shift. The long-promised appellate infrastructure is finally arriving, but the courts are, in return, demanding absolute, unyielding adherence to procedure.
The grace period is over.
Exactly.
That is the perfect way to frame this. We are moving from anticipating change to, actively navigating enforcement. So our mission for you today is a strategic shortcut through 3 massive shifts.
Okay.
First, the triumphant launch of the long-awaited Goods and Services Tax Appellate Tribunal, GSTAT. Second, we're diving deep into procedural mandates, both income tax and GST, that courts have now ruled are, mandatory, not optional.
Right.
And third, we have a landmark Supreme Court decision that redefines what payments actually qualify as tax-deductible business expenses.
A lot to cover.
Okay, let's unpack this. Starting with a moment many of us thought, frankly, might never happen.
GSTAT is here.
GSTAT is here.
Yeah, this is genuinely the most significant structural change in GST since it started. The Ministry of Finance finally operationalized it through Office Order number 032025.
And this ends that logjam, right? Where taxpayers had nowhere to go after the first appeal.
The absolute logjam. You were stuck, basically, either going to the high courts or just accepting the order.
Yep.
That's over now.
The infrastructure to fix that, it's pretty impressive. I mean, the source material specifies 83 members have been allocated. That's 49 judicial, 28 technical from the center, 6 from the state, all across the major cities. That kind of investment tells me the government is serious about clearing this backlog.
They have to be. But what it means for the assessee who's been waiting is urgency and a very specific deadline.
Okay, what's the timeline?
For legacy cases, so that's any order passed before April 1st, 2026, you have a finite window.
Okay.
Appeals have to be filed by June 30, 2026.
June 30th.
If you miss that date, you lose your statutory right to appeal to GSTAT. And given the size of the initial backlog, that 6-month window is going to fly by.
And they didn't just open the door, they changed the requirements for entry. We have the standard stuff like filing form, GST, PLO 5, and the pre-deposit.
10%, yeah, capped at 20 crore.
Right. But what's the new strategic complexity that legal teams are facing here?
The complexity is in the level of detail you need right up front. Following the new CGST Third Amendment rules, there is a brand new non-negotiable requirement.
Which is?
A mandatory statement of facts under paragraph 17 of the restructured form.
A statement of facts. That sounds simple, but for someone preparing litigation, that's huge. Why this specific addition?
Well, the government's trying to prevent vague or, speculative appeals. Historically, first appeals were sometimes filed quickly, just to meet a deadline, reserving the detailed arguments for later.
Right, placeholder appeals.
Exactly. Now, this forces the SSE to articulate the specific grounds, the evidence, the legal arguments right at the start. It's designed to streamline the GSTAT process. If your statement of facts is weak, your appeal starts on the back foot.
So the key strategic point here is that preparing for GSTAT is now mandatory front-loaded work.
Precisely.
You can't just meet the deadline. You have to submit a robust, fully articulated case by the deadline.
Precisely. And while we're on strategy, we have to talk about the interim protection that, frankly, kept a lot of businesses alive during this waiting period.
The stay on recovery.
The stay on recovery,
Yeah.
Circular 224.
Yes. So how does the launch of GSTAT affect that protection against, coercive recovery of the rest of the disputed demand?
The mechanism is still crucial. By submitting a formal undertaking with proof of your 10% pre-deposit, you get an automatic stay on the recovery of the balance.
Okay, so that protection is still there.
It's statutory. But here's the caution. Filing that undertaking is an admission that you're pursuing the GSTAT route. It might preclude challenges through other routes, like a constitutional writ down the line. Yeah. It binds you.
Ah, so it's a strategic decision. Protection now, or retain full legal flexibility.
That's the trade-off.
That's a vital distinction. Now, let's use this theme of courts demanding mandatory procedural adherence and pivot to income tax. We've seen they're building the infrastructure, but they're also sending a message. Procedural flaws are either fatal to the assessee,
or a powerful shield for the assessee.
That's it, exactly.
The message is clear. These mandatory systems are not recommendations.
Okay, here's where it gets really interesting. Let's talk about the faceless assessment mandate. The whole process shifted to faceless under Section 151A. But this ITAT Chennai ruling in Navasakti townships, it gives taxpayers a massive procedural win.
It's a tactical atomic bomb for assessees who are facing these old-style notices. The ITAT held that any reassessment notice issued by a traditional jurisdictional assessing officer,
A local AO?
a local AO, not the faceless unit, on or after March 29, 2022, is jurisdictionally invalid. It's void ab initio.
Void ab initio. I mean, that's incredibly powerful language. Invalid from the very start.
It is. They lack the fundamental power to issue it.
But practically speaking, how does an assessee prove the wrong officer issued it? Isn't the burden of proof on them?
They just need to prove jurisdiction, not intent. The law mandated the faceless mechanism. So if you receive a notice and it bears the name and physical jurisdiction of a specific AO after that March 2022 date,
That's it.
that's your argument. The ITAT emphasized this is a mandatory statutory requirement, not some administrative formality they can just ignore.
That is a critical defense for anyone who got notices in that window. Let's jump back to GST, because there was a similar trap for the department on mandatory communication.
Yes, the Delhi High Court ruling in Kurlan Retail Limited. They invalidated a full GST adjudication order.
Why?
Lack of natural justice, failed communication. The court said the authorities can't just rely on uploading a notice to the GST portal, especially if it leads to an ex parte order.
Right.
They have to show they took reasonable steps to ensure actual notice.
Meaning email and mobile alerts?
Email, mobile alerts, some form of active notification.
So if an assessee can show they checked the portal, but no email or mobile alert ever came for a hearing notice, the final order is vulnerable.
Highly vulnerable. It puts the burden of proof back on the department to show their digital systems are actually working and reaching people.
Now, for the procedural detail that turns into a very costly mistake. E-way bills. The MP High Court ruling in Amara Raja batteries. They upheld the full penalty for a geographical blunder.
And this wasn't a minor clerical error, not like a single typo in a PIN code.
No.
The e-way bill listed the destination as Indore, but the real destination was Jabalpur. That's a discrepancy of hundreds of kilometers.
Okay, that's significant.
And when the assessee is both the consignor and the consignee, courts apply heightened scrutiny. They saw this less as an honest mistake and more as a potential compliance failure that warranted the full hit.
The takeaway is clear. Major geographic errors will be treated severely.
No question.
Okay, let's pivot now to the ultimate authority, the Supreme Court, and two decisions that really reset some fundamental tax principles. We'll start with that classic high-stakes dilemma, revenue versus capital expenditure.
Specifically on non-compete payments.
Right. This ruling, Sharp Business System v. CIT-III, clarifies deductibility under Section 37(1). And it feels like a real philosophical shift.
It is a fundamental shift away from a doctrine that has guided, auditors and tax pros for decades.
So for years, we all learned the enduring benefit test, right?
Yeah.
If a business paid for something that benefited them for a long time, like a non-compete, it was often classified as capital.
Exactly. That enduring benefit test from older rulings like Alembic Chemical was the go-to. The logic was, if you spend money to secure a benefit that lasts for years, it must be for the capital structure of your business.
And the Supreme Court has now said.
They've clarified that the presence of an enduring benefit alone is no longer decisive for capital treatment.
So what is the new decisive factor?
It shifts entirely to asset creation. The court ruled that payments to restrain competition, if they merely restrain a competitor and do not create a new capital asset for the payer.
Then their revenue expenditure.
Their revenue expenditure, fully deductible under Section 37(1).
That is massive for M&A, for business buyouts. It means the tax treatment really hinges on whether you bought something tangible, an asset, goodwill, or if you just paid a competitor to step aside for a few years.
That's the distinction. If it's the latter, it's just a cost of earning revenue now. It simplifies things tremendously.
Okay, moving to another critical SC ruling, this one impacting search assessments under Section 153C.
Right. In CITV's Singad Technical Education Society, the Supreme Court really reinforced the strict requirements for using this section.
This is the section that lets them reopen assessments based on materials seized in a search.
It is. And the SC stressed that the revenue has to demonstrate a specific correlation between the seized documents and the particular assessment year being reopened.
No more fishing expeditions, in other words.
That's the essence of it, yes. A blanket invocation based on generalized allegations that these funds relate to an earlier period is now invalid. If they want to reassess AY 2018-19, they need to show seized material that specifically pertains to that year.
A powerful check on those search assessment powers.
It is.
And finally, a reminder from the highest court about respecting the appellate hierarchy itself.
That's the ruling in Kemchan Uttamchan Bhujwani, a core principle. Once a final assessment order is issued, the proper mandatory course of action is to file an appeal with the CIT-III.
You can't just bypass it and go to the high court with a writ.
Generally not. You can't do it just because you dislike the pre-deposit or think the process is too slow. Exhaust your statutory remedies first.
That wraps up the big court decisions. Let's get into the necessary action items, focusing on those high-risk compliance areas that could instantly land you in hot water. Starting with foreign assets and the infamous Schedule FA.
Schedule FA reporting is mandatory for every resident and ordinarily resident SSE, period. Even if the asset makes no income or the income is taxed abroad, you have to disclose it.
Now, there was an amendment in October 2024 that gave a penalty shield for smaller assets.
Right, for aggregate movable assets below 20 lakh rupees. And that's helpful, but the crucial point is the reporting requirement still stands. The shield is for the penalty, not the filing.
And I've seen people get tripped up on this. What if someone, say a spouse, is a joint holder but never actually funded the asset? Do they still have to report?
Oh, absolutely.
Yeah.
The compliance duty is separate for each joint holder. Even a non-funding spouse has to file a complete Schedule FA disclosure.
And how should they classify that?
As a beneficiary or joint owner, but the duty to disclose is triggered by legal ownership or beneficial interest, not who paid for it. Missing this can trigger huge penalties under the Black Money Act.
Which links a simple income tax reporting failure to the most stringent penalty regime we have. A serious warning.
Very serious.
Next, let's talk property purchases, specifically when a domestic deal suddenly becomes an international one.
This is the mandatory switch from Section 194-IA to Section 195 when you buy property from an NRI. If you, the buyer, default to the standard 194-IA, which is for resident sellers, you'll be deemed an SSE in default.
And the deduction requirement under 195 is totally different, right? It's not just based on the capital gain.
Correct, and this is the critical part. Tax has to be deducted on the full sale consideration, the gross value, not just the seller's calculated capital gains.
And the only way around that is?
The NRI seller has to produce a lower deduction certificate from the tax department. If they don't have one, you deduct tax on the gross amount, or you are held liable for that shortfall.
Okay, finally, a quick check on PMLA enforcement powers, specifically about non-bailable warrants after an ED summons.
The Delhi High Court provided a really essential check on the ED's powers in the Sachin Dev Duggal case. The court ruled that non-bailable warrants, or NBWs, can't be issued solely for ignoring an ED summons under Section 50 of PMLA.
So just not showing up doesn't automatically mean a warrant can be issued for your arrest.
Precisely. The court confirmed that NBWs are reserved for much more severe circumstances: escaped convicts, proclaimed offenders, or someone actively evading arrest for a specific scheduled offense. It ensures that Section 50 noncompliance, while serious, doesn't automatically trigger such a harsh measure.
So what does this all mean? I mean, we've covered ground from the GST Tribunal finally being live to the Supreme Court clarifying business deduction rules and these procedural wins that can act as shields.
The key takeaway is that the regulatory landscape is shifting profoundly. The era of waiting for infrastructure, GSTAT is here, is giving way to an era of rigorously enforcing digital and jurisdictional procedures.
The faceless mandate isn't just an idea anymore.
It's a legal requirement that courts will uphold.
These recent rulings mean that procedural challenges are now potent weapons for SSEs if they're deployed correctly. But beyond litigation strategy, the source material highlights these compliance cliff dates that demand immediate action right now.
Yes. First, you have to mark December 31st, 2025. This is the absolute final chance to file a belated income tax return for AY 2025-26 with just the modest fixed late fee.
Miss that, and the liability escalates
Significantly. Next, look ahead to March 31st, 2026. This is the critical threshold for AY 2024-25 updated returns.
Okay.
File before that date, your additional tax rate is 25%. File after, it jumps to a steep 50%.
That's a huge incentive for speed.
It's a massive incentive.
Yeah.
And finally, circling back to GSTAT, remember that June 30, 2026 deadline. It's the last chance for years of pending disputes on those legacy orders.
So the final provocative thought for you to consider is this. How quickly can your operational framework adapt to treat mandatory digital and jurisdictional rules like the faceless requirement, the new GSTAT APL05 formats, and precise e-way bill entries, not as mere bureaucratic formalities, but as foundational legal defenses against future litigation? Compliance is officially the cheapest form of litigation prevention.